Okay, let's get right to it. It's October 17th, 2025. The market is at a major inflection point, caught in a tug-of-war between two massive forces, a hurricane of macro risks and a solid structural floor holding prices up. We're going to break down exactly what that means.
So the question for everyone right now is simple. What's it going to be? A bull rally or a complete bear collapse? The market is coiled tight at a critical level, and the next big directional move is about to begin. The direction isn't certain, but the trigger points are crystal clear.
All right, let's break this down. On one side, you have all the macro fears giving you a reason to be cautious. We're talking escalating geopolitics, new stress in the banking sector, and a government shutdown that's just bleeding cash. But pulling in the other direction, you've got these incredibly powerful structural supports, a massive fiscal deficit that's basically stimulus, a Fed that's still accommodative, and corporate margins that are just refusing to quit. These are two giant forces colliding head-on.
And what this all means is that the entire market structure is balanced on a knife's edge. Seriously, the next major leg for the whole market could be decided right from this one spot.
And that spot is 6550 on the S&P 500. Now, this isn't just some random line on a chart. This is a huge support zone, mainly because this is where the options dealers have their big positions stacked. It also lines up perfectly with the 50-day exponential moving average, a key trend indicator for a lot of funds. You can think of it as the market's ultimate line in the sand. How price reacts here is going to tell us everything.
So first, let's unpack the bear case, what I'm calling the macro hurricane. There are several major headwinds all hitting at the same time, and they make a very compelling argument for being cautious, if not outright bearish.
We're really facing a trifecta of risk here. First, that banking stress is bubbling up again, and we're seeing early signs of credit problems. Second, the trade war with China looks like it's about to escalate in a big way. And third, the ongoing government shutdown is creating instability right here at home, just draining resources.
You know, the JP Morgan CEO has this great quote, "When you see one cockroach, there are probably more." And that feels right for the banking sector now. This isn't just some abstract fear. We're seeing Zions Bancorporation report a $50 million charge-off. We're seeing Western Alliance deal with fraud allegations. The real danger here isn't one bank, it's contagion.
On the geopolitical front, the number you need to have circled on your calendar is 100%. That's the proposed additional tariff on Chinese goods, and it's scheduled for November 1st. Look, this is not a small adjustment. This is a massive escalation that could throw a real wrench in supply chains and corporate profits.
And here's the drag from inside our own house. That government shutdown, it's costing about $400 million a day. A day, just in payments to federal employees who aren't working. That's a direct weight on the economy with absolutely zero productive output to show for it.
Okay, now for the other side of the trade. Despite all those very real risks, there is an incredibly powerful structural floor that's been holding this market up. And we're not talking about minor things. These are huge systemic forces.
The bull case really stands on three main pillars. First, you've got massive fiscal stimulus being pumped into the system from the government deficit. Second, the Fed's policy is still pretty loose, which supports asset prices. And third, and maybe most importantly, corporate earnings have just been unbelievably resilient.
This number right here is the key. $2 trillion. That's the annual deficit from the U.S. government. That's basically a fire hose of cash being sprayed into the economy. All that money has to go somewhere, and a big chunk of it is flowing straight into financial assets, pushing valuations higher.
And here's the fundamental support holding it all together. Despite inflation, despite the geopolitics, despite everything, corporate profit margins are still hanging out right near their all-time highs. As long as companies are printing money like this, it provides a very firm floor for stock prices.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice.
So, now that we've defined these two opposing forces, let's bring it all back to that inflection point and lay out some actual scenarios. This is where we turn the theory into a tactical trading plan.
Here's the simple if-then logic at 6550. Our base case is that we see choppy sideways action as long as the market stays above that level. The bull trigger? That would be a strong, decisive bounce off of 6550, confirming it as support. And the bear trigger? A clean break and, more importantly, a close below 6550. That would open the door for a much bigger move down.
To put targets on it, the bull thesis is that the structural floor holds and the market starts grinding towards 7,000, which is the next huge options gamma level up. The bear thesis, on the other hand, is that the macro hurricane finally breaks support, forcing dealers to sell, and that accelerates a move down to the next major gamma level at 6,000. The entire battle is between those two levels.
All right, let's translate this into some actionable, risk-defined setups. This is the playbook for how to approach this market structure right now.
If you're leaning bearish, you're looking for signs of weakness. KRE, the regional banking ETF, is a direct play on that credit stress we talked about. You could use long puts, or maybe a put debit spread. Spec tech names like Palantir and AFRM are already showing technical breakdowns. They'll get hit first and hardest in a real risk-off move. The key risk to any short trade? A sudden positive headline that causes a violent reversal higher.
Now, on the bullish side, you want to focus on relative strength. Names like AMD and Google are coiling up in tight consolidations looking like they have breakout potential. A call debit spread could be a good way to define your risk there. For names that have already pulled back, like the Russell 2000 ETF and Amazon, you could look for an opportunity to buy on a dip to key support. Of course, the biggest risk for any of these is the S&P failing to hold 6550. That level is your line in the sand.
And finally, here are a few other ideas to consider. You can always use puts on the QQQ as a straightforward portfolio hedge against a tech sell-off. MP Minerals is an interesting way to play the onshoring trend for rare earth metals, which is a big geopolitical theme. And for a direct, speculative bet on volatility itself, there's UVXY. But be warned, options on leveraged products like that are extremely risky. Know what you're doing.
Not trading advice, just a market update to keep you informed. Markets carry risk, trade your plan, manage downside, and verify all data.
So, the board is set. The levels are clear. The question for every single trader right now is which force is going to win, the macro hurricane or the structural floor? Your positioning from here on out should depend entirely on your answer to that question.